Just opening this up. We're right at the top of the hour. I'm going to give it a few minutes, let people log in here while you are logging in, or while Zoom is letting people in. If you could go into the chat and, yeah, although sometimes I think chat doesn't work, but try it. Go in the chat. Let me know that you hear me, that you see my slides with the title Tax Season Challenges on there. So I know we're good to go to get started. Chat is working. All right. Thank you, Sarah. Appreciate it. I'm going to give it a few minutes. Loud and clear, Robert. Thank you. We got quite a few people registered for today, so I'm going to give it a few minutes to get going. And Marie, working good. Jerry. Hey, Jerry. And let's get this going. All right. While people are gone to log in, this is a minute after start. So while people are logging in, let me go through a few housekeeping items to get us going today. This is a presentation available for continuing education. CPE, continuing professional education, is available. You have a couple requirements. You have to stay logged in for 50 minutes. We will keep this open probably entire hour. So you need to stay logged in for 50 minutes, 50. And you need to answer 3 of the 4 polling questions that I will let you know when they pop up during the presentation. If you are logged in through a web page rather than the Zoom app, computers can download the Zoom app. It's not just a phone thing. If you're on a web Zoom version, you will need to disable your pop-up blocker, because if you have your pop-up blocker on, you will not see the polling questions. If you're having issues with that, just answer the polls in the chat, I think, is where we want it. And we will see. Just answer the polls there in case you have a problem. But the only problem you should have with seeing the polls is if you are logged in through a browser rather than through the Zoom app. All right, let's get going on this, and I'll introduce our behind the scenes co-presenter question answers as we go. But today's presentation is, you see the title, Tax Season Challenges, ERC filings, and 174 capitalization. Items that can cause some issues this tax season. We'll explain why, and we'll explain what we are advising preparers to do when they run into certain situations. Phil Williams is unfortunately not here today, but Phil's dug deep into the 174. So if there are follow-up questions, Phil will probably be answering those, as well as Nick and myself and Barry. You see Nick online right now. You see the picture of Nick live and in person. Nick will be answering any questions that come in as they are typed in, maybe not like the second they are typed in, but within a few minutes afterwards, as long as there's not a ton of them. If we don't get to all the questions, we'll try to answer them after the presentation. And if there's anything Nick thinks that we need to address to the whole audience, he will break in during a polling question probably, and we will answer that. Barry, I'm not sure he's going to get on, but if he is, he will also be answering questions. There's me. I'm Randy. I'll be doing most of the talking today. I'm a CPA, came out of public accounting 17 years ago, started Tri-Merit 16 years ago. And pretty much what I do these days is educate through webinars, through speaking at conferences, through a podcast, writing articles, and really enjoying this aspect of the business. Quick, just about Tri-Merit. Tri-Merit is the one who puts these on. It's a Tri-Merit in conjunction with the Unique CPA. The Unique CPA is my podcast and overall brand that we use to educate the profession. What Tri-Merit does is we support tax preparers through credits and incentives, help them and their clients save money, increase cash flow by identifying different credits and incentives available to different taxpayers. Not every credit incentive is available to every taxpayer, which we'll talk about when we talk about ERC today, because unfortunately there's some people out there that think ERC is available to everybody, and it is not. I assume you all already knew that, but some people seem not to know that. One thing I want to point out, our core services have been 6 items. We really have added a 7th, 8th, 9th. You can look at it, how many opportunities there are, but the Inflation Reduction Act created some nice tax credits available, investment tax credits, production tax credits that officially we will be announcing. I guess I'm officially announcing it now, but the real official announcement is March 1st. So next week we will be putting out information on what those service offerings are and how you as the advisor, how you as the tax preparer / advisor can bring tax saving opportunities to your clients. And then just quick, we're very proud of the fact that the work we do has allowed us to grow very rapidly, and that's because of the individuals like you on this presentation that are working with us. Okay, so what's the agenda? Really 2 items, and we saw it in the title. ERC, you're all seeing it. You're all seeing all the marketing that's going on the ERC out there. We're going to talk about that. We're going to talk about the misinformation. We're going to talk about how you truly qualify, which is a lot smaller of a qualification subset than you probably are hearing with the marketing out there, at least in our opinion. So we'll get into that. We'll get into 174. 174 is the IRS Code Section 174, which defines, you can look at it 2 ways: research and experimentation expenditures or research and development expenditures, R&D or R&E. I'll probably use them interchangeably as we talk today, but we'll discuss why this is an issue and what we need to be doing as tax preparers / advisors. I really like adding that advisor to preparers because you're more than a reporter. You are an advisor, an effector. You as this advisor can affect the bottom line tax return to your clients, and that's really the way this should be going. And so this whole 174 is going to be probably the last 2/3 of the entire presentation. First 2/3 be on ERC. That being said, attention, we are doing poll question 1 just to kick things off here. I'm going to launch the first polling question. Please make sure you answer this. If you are not seeing it, again, it could be a pop-up blocker in your browser. And if that's the case, just answer in the chat, please. But the question is, have any clients filed an ERC claim that you are uncomfortable with? And there's going to be quite a few out there. And after we talk today, you might have an uncomfort level with some more that you're seeing. There's plenty of clients out there that I'm sure every tax preparer, tax advisor has told me they've said to the client, no, you don't qualify for ERC. And then the next thing you knew, someone else promised them they do qualify, and then they've got a refund check sitting in their account. So there's going to be some of that out there. We're 49 seconds into this. It looks like 92% of you have participated. I'm about to close this. And in fact, I'm closing it right now. So I'll give you 2 more seconds. If you haven't participated in the poll, do so now. I'm ending the poll. And I'll just let you know, 49% of you have concerns. So almost half of you have concerns that there's been some ERC claims filed by your clients that you're not comfortable with. I'm not surprised by that number. And honestly, it probably should be higher than that because there's plenty of them that I see. On a daily basis, we're seeing claims that clients shouldn't be taking. So it's unfortunate, but it's out there. So let's jump into that then with these claims. Why is there a concern on these claims? Well, there's a lot of concerns. As a tax preparer, if there's a claim out there that is not legitimate, not, what's the terminology, more likely than not that they'll be held up or whatever the terminology is, you have to have concerns as a tax preparer on what you need to do with that. One, in both of these situations, 174 and ERC, you can have either underreporting of income, you can have overreporting of taxable income. That's an issue too. That is an overreporting of income on a financial statement. That can be a significant issue too if you are the one that is putting these financial statements out. Misrepresentation on there. You have failure to pay penalties. You have failure to file penalties. With ERC, if you were filing one that was inaccurate, there is payroll tax penalties, which can be tremendous. And so the concerns are, yes, we need to do our responsibility. IRS gives us this responsibility is to file an accurate income tax return. And both the 174 and the ERC could cause us to file something, whether we know it or not, that it's inaccurate. And so that's a concern that we have to deal with. AICPA just came out, and I think this was last week. They just came out with their risk. It's actually titled exactly what I typed in there. Risk alert. Aggressive employee retention credit calculations can create, and I'm blocking that, create professional liability risk. That's for sure. That is potential out there. AICPA is going pretty extreme with this. I don't think they wrote this article. I think they reposted it from someone else, but it's on their website. And they were going pretty extreme with the fact that if there's an ERC claim that you don't feel is legit, they don't think you can file that income tax return. That's what they're saying. They don't think that you can sign that income tax return. And that very well could be the case. And so I would definitely look at this slide. Copy paste, go search for that. If I get a chance during a polling question, maybe I'll throw the link into the chat so you can see it. But just be aware of that. In this, just as some highlights in this, don't sign any 941Xs that are prepared by third parties. I know some third parties will not file the 941X, and AICPA is accurate in this. I think you should not be filing those. So these are headaches you want to try to avoid. There's some issues out there with, there's an extended statute on some of these ERC claims that IRS has 5 years for some of the quarters to go audit. Well, the income tax statutes could very well run out before that. And if we get an adjustment 5 years down the road, you may not have the ability to go adjust an income tax return. So there's concerns there. And there's IRS or AICPA is cautioning filing an amended return when the position is deemed unreasonable. So just be aware of that. I just wanted to highlight, this is some new information that came out. And just as another thing that just came out last week, IRS put out some information on the fact that they have started an investigation on 44 ERC claims, which seems very low. It may be ERC providers too, because I know the first one, there was a provider that was indicted last week for filing false ERC claims. This is not going to be the end of that. You're going to see a lot of that, unfortunately, and this is my opinion, but IRS and AICPA and others agree. There's a lot of inaccurate information and inaccurate and going as far as saying fraudulent claims out there on ERC. So let's start with the ERC first then. And what I'm not going to spend a lot of time on ERC because we've all seen it, we all know it, but I want to dig a little deeper on what it is that you need to look at for your clients to qualify, because it's not nearly as broad as you're hearing. Qualification is really very simple. It is not, hey, we had to wear a mask, we qualify. Or it is not, OSHA put out rules and we have to qualify and we can qualify. It is not, we had to put up plastic partitions and therefore we qualify. There has to be an impact. So there's two ways you can qualify. Really, this is it. It is, and you can expand on these a little, but I'm trying to be hard to the point here. One, the drop in revenue. That's a no-brainer. If you have the drop in revenue calculation, 50% for 2020, 20% for 21, always compared to 19, you have that drop in revenue. It is a safe harbor, no questions asked, you qualify. And often that'll bring in another quarter as well. So that's a no-brainer. That one's fine. The second one is where people get this expanded and they go from here's how you qualify to the funnel keeps getting larger at the top, or I should say almost invert. We have a small qualification and it keeps getting bigger when it gets down to some people talking about it. But you can qualify if you were fully or partially suspended due to a government mandate. And this really needs to have a direct effect on you. There has to be an impact. That's like those things I was saying at the beginning. There were not impacts on, I had to wear a mask, so now I'm affected, I qualify. No, it's not the case. Really, and I'm going to pick a number, and I don't know for sure. Nick probably has a better idea. We've probably filed for $500 million in refunds. You hear other providers will talk about billions. I'm concerned about billions, but we've filed for quite a few. That's thousands and thousands of 941Xs. One of the things you hear is that people are promising ERC credits based on supply chain issues. of the 500 million or the $500 million we've done, 0 have been supply chain. So when you're looking at your client qualifying and you're hearing that there's more qualifications other than just a direct impact, restaurant, we're closed for indoor dining. That's a direct impact. Or we reduce the capacity, our restrictions on capacity for our restaurant. That's a direct impact. You can have an indirect impact if it is to a small portion of your business. Let's say we have a bar and a restaurant and a liquor store, and they're all in one business. The liquor store stayed open, the other 2 were closed. The fact that a portion of the business was under a mandate is good enough. We have to prove that a portion was affected, a portion that we can segment out. So if you're hearing your clients that are qualifying based on things other than that, I would start to question, I would dig deeper into how that qualification was determined. So really, it's not, and this is my opinion, our opinion as Trimerit, it's not this wide area of things that can qualify. It is really these 2 things you see on the slide. And the second one is not this gigantic, all-encompassing, everything qualifies if we had any ounce of impact. That's not the case. All right, I probably went too long on that already. Here are some things. Partial suspension. The restaurant example I already told you. The limitation on capacity I already told you. Changing from indoor dining to carry out. That's an impact that qualifies. I reduce the number of hours that I could be open due to a government mandate, not due to my decision. That can qualify. Medical. Most medical around the country for a certain amount of time was impacted by the fact that they could do emergency procedures, not elective procedures. That's an impact that directly affected them. That's a segment of their business, elective procedures that I can pull out and I can identify if there was an impact to that. If it's, hey, we had to have people waiting in their cars rather than our waiting room, and if that had no impact in the number of patients you could see, even though that's an impact to your business, there's nothing I can quantify to show that's an impact. That won't qualify you. So just be careful with this and make sure that you have strong documentation to support how a client was impacted and how that affected at least a portion of their business, a segmented portion of their business, not just, hey, look at my revenue was off 10%, therefore I qualify. And I hear that all the time. That's not the case. I have to show that I have a segment of my business that was at least 10% of my revenue in 2019, and that segment was affected by a government mandate. All right, I'm ranting. I can get at my soapbox for this for a while. There's just some more information in here on things, altering behavior, masks, all this kind of stuff. Just be careful with this. Why are we seeing all this? Why are we seeing so, in my mind, aggressive qualification? Because the dollars are huge. The dollars can be tremendous. And anytime there's big dollars, you're going to find people that are want to get aggressive and probably, in my mind, cross that line to qualification. So just be aware of that. The one that I really want to focus on a little bit longer, and then we're going to go to 174, is the supplier issue. Everybody gets, you've heard this. Hey, have you been affected by supply chain issues? And everybody will say, yes, there has been. It's been across the country. We've had these issues started in 2020. Most of these supply chain issues were basically a demand issue. As a country, we just started buying in 2020. We went crazy with what we were buying. Probably some was hoarding with toilet paper and other things, but other was just demand went crazy. And at the same time demand went crazy, supply chain of employees went down because people weren't working. Now, they weren't working because of a government mandate. They weren't working because they chose not to work, and they could get unemployment and make more money than they were making in their job. And so far, with a combination of a lack of employees and an increased demand, it did cause global supply chain issues. Unfortunately, almost all of those supply chain issues weren't based on a government mandate, or at least a government mandate that is going to qualify you. And I knew I was going to get this question. I didn't address it at the beginning, but someone asked if there's handouts available. Yes, there are handouts available. They will go out to you tomorrow morning. If I have time, I will try to drop them in the chat today, but the handouts will go out to you. You'll get them in an email tomorrow. So just be aware of that. All right, so supply chain. Supply chain, let's say I am a business and my supplier was affected by a government mandate. That very well could be happening. Now, that's not where I stop. I don't stop there and say, hey, my supplier was affected by a government mandate and that affected me. I have to go further and prove I could not replace those supplies somewhere else. I couldn't get different materials. I couldn't get another supplier. I couldn't use, instead of copper or brass, or I'm just making things up. But I have to show that there was no option in the world that I could have done that would have changed or would have been able to help me avoid the supply chain issue. So that's the problem with supply chain, is it's not as cut and dry. It's not everybody knows their supply chain issue, so we all qualify. That is not the case. We have to show a direct impact and that we had no recourse to, get around this in any way. Just we're going to manufacture different. We're going to resupply, or we're going to redesign our products to use different materials, but we can continue to do this. If that was the case, not a supply chain issue. And again, we've done zero supply chain qualifications at this point. You can't. I mean, IRS specifically says, but then they make it restrictive. The other thing is client base issues do not qualify, customer base issues do not qualify your client. If their customers were shut down, IRS specifically says that is not a government mandate that affects you directly. It's indirectly. Your customers are affected. A lack of demand doesn't qualify you. So be aware of that. Be cautious of that. Ask questions, because you are on the hook for this. You're liable in AICPA's eyes if you're filing an income tax return even with this on it. OSHA guidelines, I'm not going to go deep into this. I'm just going to tell you, OSHA does not create a mandate that your clients had to qualify or follow that created a ERC qualification. It just doesn't happen. Buddy of mine, Dan Choden, wrote this article in Think Outside the Tax Box, which will explain why it doesn't qualify. Go take a look at that, but it won't. And many of you may know Dan. Dan's been on the forefront of ERC. He and I have been in contact for a long time and talk about this and make sure that we're doing things for clients that are going to be defendable in front of the IRS. One last thing on ERC, and already going too long on ERC, you just get me going. This is such a hot topic, and you're seeing it, and it's something you shouldn't have to deal with during tax season, but you are, because you're getting surprised. You're having clients show up to do the 2022 return, and you're seeing a big deposits go into their books in the 2022 financial statements, and you find out it's an ERC, and now what do you do with that? Well, from an income tax standpoint, you have to, IRS has said this, you have to make the adjustment for that ERC qualification, that ERC money, in the year that the wages were used for the calculation. So if you have a client that got $2 million of refunds in 2022, you do not pick up that $2 million of income in 2022. You have to go reduce your expenses in the year that the wages were used, which would be 20 or 21. So just be aware of that. There's no way around that. This is the way the IRS has said it. And I've heard people say, well, we're just going to pick it up in the current tax year because it's just a timing issue. It's not the guidance we have. The guidance we have says you have to go amend. At least from going to amend, the IRS has said, we don't want to penalize you. We know we're running things slow. IRS is saying this. We know we're running things slow. And so therefore, we want you to avoid penalty. We don't want to penalize you. If you do get a penalty, just send a form back and just say, hey, based on IRS notice 2149, where you say you're not going to penalize us, we're asking for an abatement of the penalty. And that's what I would do. And then if you do find that they have this refund, you need to go amend that return as soon as possible. This is going to be putting you in the best situation to avoid a penalty. And so even if they can't pay it, even if they haven't got the refunds yet, go amend the income tax return for the year that the wages were used. Just do it and then go through a process of asking for penalty abatement. All right, that's my ERC rant for the day. Went a little longer than I did this last week. We're going to go on poll number 2. And so, are you concerned about filing an amended income tax return for an ERC claim you are not sure has a realistic possibility of being upheld? And not to sway you, but AICPA says you should be concerned about that. And so be aware of that. While this is up there, I'm going to see if I can put the link to that AICPA. Give me 1 second. That AICPA risk alert. Actually, I can't right now. We'll send that out to you afterwards with the other stuff, slides. All right. We are at 89% answering this poll. I want to move on to the information. So if you have not answered this poll, just poll is up now. If you have not answered this poll, please do so because I'm going to close it in 3 seconds here. All right, this poll's closing. Ending at 71% of you are concerned about filing an income tax return with an inaccurate ERC claim on it. You know, that's exactly what AICPA is saying as well. So I would be concerned about that. All right, now let's get into really the other major issue. And some of you may not even know this is a major issue that you need to deal with. I'm guessing the fact that you're on here, you have an idea if there's something that you need to be dealing with here. But this is the required, kicked in December 1st of 22, require capitalization of 174 expenses. Like I said at the beginning, R&D, R&E, research and development, research and experimentation expenditures. We have to capitalize these and amortize them. New rule kicked in. When we're talking about this, then, what's the client base that you should be thinking about at a minimum that this will have an effect on? Well, it's the same client base that would be for an R&D tax credit for the most part, which is a manufacturer, number 1, software developers, number 2, architects, engineering firms. Those are the top 4. But in reality, you are going to find, or there is the potential of finding 174 research and experimentation expenditures in potentially any client. Now, you're not going to find it in every client. So it's not like some people say that every client qualifies for ERC. 174 is not every client's going to have a 174 expense, but you're going to be surprised by some clients that do. And to go back to that example I was using earlier for ERC, bar, restaurant, liquor store, all combination of one. I am a partner in a place that has a bar, has a liquor store, and we're currently building out a restaurant. 3 segments of the business. The liquor store portion did a bunch of software development to create an online store at the beginning of the pandemic and for the next few years afterwards. We developed this online store through software development. Software development is an activity that qualifies for 174. So I have a liquor store that has to identify research and experimentation expenditures. That's why I'm saying there are areas that you'll see 174 expenses that you never would have thought would have R&D expenses. So let's dig a little deeper then on what 174 is. This is, again, code section 174. The R&D tax credit is code section 41. The 4 expenditures that qualify under code section 41 all have to qualify under 174 first, but the number of expenses that qualify for the R&D expenses is much greater than what qualifies for the R&D credit. So that we have a broad definition of what a 174 expense is. That broad definition is, and this is part of the problem, we don't have a really succinct definition, but in this broad definition, what we have is that all cost incidental to the development or improvement of a product, process, technique, pilot formula, pilot model, invention, patent, similar property, all the expenditures involved with this qualify as a 174. Okay, that's a broad definition. If we dig deeper, what are these costs that are incidental to the development or improvement of a product, process, etc.? Well, IRS tells us that includes, cost of attainment a patent, not cost of acquiring a patentable product from someone else, but cost of us patenting our product, which would include attorney fees, some other costs. Wages are 174, utilities, overhead, materials, rent, depreciation, software development costs. These are all considered 174 expenses. The overhead one is where we're going to spend a little more time as we go here, because what does that mean? But these are costs for 174, whether we're using it internally, like the bar, liquor store creating the software for online ordering, or it's something that we are going to hold for sale. We develop a widget, we're selling it. It doesn't matter how we're using it internally or externally. It can be a 174 expenditure. In addition, we have a definition of what is not 174, which helps us dial in 174, because again, we don't have a ton of 174 guidance. And I'll explain this in a second. We've never had to have it. And I'll tell you why in a second, but we don't have a ton. But I'm going to give you, before we wrap up today, I'm going to give you a flow chart of how you can get to a 174 expense, at least to a point where you can estimate the amount of capitalization for doing an extension this year, which I'm doing a spoiler alert here. Our recommendation is anybody who we think has 174 should go on extension this year while we wait for more guidance from the IRS or while we wait for Congress to act and change these rules. That could still happen. It's looking less and less likely, but I'm still holding out hope. So what's not a 174? This is specifically called out for us. Acquisition of an existing patent, not our own, someone else's product, model, production process, acquisition of land or improvement of land, depreciable, depletable property, oil and gas exploration are actually in 174 identified as not an R&D, not a 174 expenditure. Testing and quality control of a production product, no. Testing and quality control of a prototype, yes. Consumer surveys, management studies, advertising or promotion, research for literary, historical, or similar project, those are not 174. So we've got on the previous slide, here's expenses. We have all the expenses incidental. Here are some of the activities that don't qualify. And now let's just do a quick history story. I'm sure some of you like history. And this sets the stage of where we are, because we've been in one specific area for almost 70 years with research and development expenditures. Prior to the IRS Code of 1954, there was no specific definition other than the fact, and we're talking 70 years ago, other than the fact that if we had a product that was based on research and development, we had to capitalize those costs and amortize them over the useful life of the product. If we didn't know the useful life, then we just kept it capitalized on our books, and we wrote it off when we sold it or scrapped it. That was the rule before 1954. Starting in 1954, which I'll guarantee all of us, our entire life working on taxes has been under these rules. Started in 1954, the IRS Code of 1954 defined 174 expenditures and gave us two options. We could expense R&D expenses as they were incurred, and simply do that by electing to do that. The first year we had R&D expenses, we expensed them. It was an automatic election. We didn't have to do anything. And this is why we never had to identify 174 before, because we didn't have, there was no need to. We just expensed them as incurred. Or we could identify them and capitalize them and amortize them over 60 months. For the most part, nobody did, and I'm generalizing. There's a few companies that did, but for the most part, they didn't. They expensed them as incurred, making this election that they didn't even know they made. Excuse me 1 second. Shouldn't have had those potato chips before I started presenting. Over the years, not much has changed. I mean, our entire lives of dealing with 174 has not changed, other than a couple simple little changes. And I only identify this first one just to show you where we sit. In 1989, they said that 174 expenses are limited to those that are reasonable under the circumstance. Again, not very in that exact on the definition. That's the only reason I put that there. But there was a major change that is going to have a major impact to us that happened in 2014, which to me seems like yesterday, but we're almost 9 years ago with this. IRS changed the rules. There was guidance that came out to say, hey, there's a new 174 rule that if you are developing a prototype or a pilot model and there's uncertainty the entire process of developing that, all the expenses that went into that prototype or pilot model are 174 expenses. Everything that went into it. Those costs that we looked at the beginning, all of those are 174. And therefore, they could, in 2014 and until the end of 21, could be expensed as incurred. It didn't matter the outcome of the project. If the outcome was a product that we sold before these rules, that would have become a cost of goods sold. After these rules, doesn't matter. They were all written off already as 174 expenses. If it was a final outcome was it was a product that we used internally, let's say a significant fixed asset, we capitalized it, we depreciated it, no longer matters. If there's uncertainty in the entire process, all the costs that went in there are 174 and expense as incurred until January 1st and 22, when we have to start to capitalize those. So this rule that kicked in 2014 creates more 174 expenses, which was great for an 8-year run, not great starting in the year 22. Next slide. All right. So where are we now? So that's kind of setting the stage. Where are we now? And again, I'm going to give you solutions, or at least solutions that we can base our estimates on at this point. But where are we right now? Well, the Tax Cut and Jobs Act of 2017, so we're 5.5 years past this now, defined a new way to treat 174 expenses, R&D expenses. And this new way was, starting in the year 2022, they defined this in 17, they kicked it down the road till 22. Starting in the year 22, we can no longer expense R&D expenses as incurred. We have to, we're required to capitalize these and amortize them if it's a US-based expense over 60 months. If it's a foreign-based expense, over 180 months or 15 years. So you can already see there with these new rules, it may make sense to start reshoring some R&D because I can write them off quicker than common outsourcing software development overseas. That's really common. That may change how people look at this because now I have to capitalize these and I'd rather write it off over 5 years than over 15 years. Why did they do this? They did this as a way to show how they were going to pay for all the cuts in the Tax Cut and Jobs Act. And their estimates were this was going to generate anywhere from 15 to 150 billion of additional revenue over a 10-year period. So that's why this kicked in. They delayed it because, in my mind, and I assume this is probably accurate, although I'm putting words in Congress's mouth now, they delayed it because they didn't expect this to really kick in. They thought, let's define it, let's show it as a way we're going to pay for this, and then we'll figure out a way to change this down the road. And that is really where the problem is right now. Nobody knows how to identify a 174. Some of you may have some idea, but nobody's had to be an expert on this for the most part before because it was an automatic election, you expense these. And so now we're left with companies scrambling to try to figure out how to identify what in their salaries and wages, what in their overhead, what in their G&A, what in their rent, depreciation, what portion of that is a 174 expense. It became a nightmare, really, especially, and I've been talking about this for 5-6 years now, 5.5 years. I've been talking about it. I even though the hope was this would go away, I've been warning everybody that this is coming. And I think we all kind of like, yeah, it's coming, but Congress is going to change it. And now we're all like, hey, this came, what am I going to do? And we're scrambling. It's just the way it is. Everybody's scrambling. I've done this presentation for thousands and thousands and thousands of CPAs, tax preparers around the country, and everybody's scrambling. Everybody's in the same boat right now. Everybody's coming up with their own plan on how they're going to deal with this. And I'll give you what most people are telling me here in a minute. Now, even though we've got a problem here, at least IRS made a little bit of a easy path for us to at least start to initiate this with our clients. And that is, we can avoid doing a 3115 change of accounting method. When this originally happened, we were all going to have to do 3115s for every client that was filing a tax return that had 174 expenses on it. That changed end of last year, where IRS came out and said, okay, rather than doing 3115, which I don't know anybody that likes doing 3115s. If you are that person, let me know. I might be able to send you business, but I don't know anybody that likes doing the 3115. IRS came out and said this, in lieu of a 3115, what you're going to need to do is just file this form with the return telling us that you're making this change and answer a handful of questions. Makes it easier. My guess is, so I haven't looked, but my guess is software hasn't built this in. You know how most software packages will have a little check mark to make automatic elections. This won't be just a check mark. This won't be a fill in the box. This will be, here's 5 answers to why you're making this change. We've put a form together. I think we're able to share that. So if anybody's curious, maybe we'll have that available, or maybe put a link on our website at some time soon for the form that we are going to use, or we're going to use with our clients for submitting this change. So that was a nice, at least making it a little easier. Before we go deeper into this now, I'm going to go polling question number 3, and we are actually doing pretty decent time-wise. Do you plan on extending tax returns for clients you feel may have 174 expenses? Polling question 3 is up, is now up. If you can answer that, do you plan on extending tax returns for clients you feel may have 174 expenses? And I'll just tell you, I've done this presentation, or I actually have one that's just 174, not including ERC, for, I would say, 10 different CPA firms in the last month. Most of them probably top 100, top 200 CPA firms. And the policy that I'm seeing pretty consistent, not even pretty consistent, I think across the board, the policy I'm seeing that they're all installing is everybody's going on extension. If there's an idea there's a 174 expense, they're going on extension. I have a couple firms that already put every pass-through entity on extension. They're just doing it. That may have been their policy before. I don't think it was. But so that's what's out there. For the most part, everybody's going on extension. All right, we're 93% participated. We're a minute in. I'm going to end this poll right now, and 92% of you say yes, that is the plan, to extend any return where you think there may be a 174 expense on it. And I think that's a great plan. Yes.
Can I jump in real quick? Yep. A couple people posted a couple good questions in the chat. For some reason, it's not letting us respond to you directly in the chat. If you post a question in the chat, if you can just repost it in the Q&A section, we'll be able to respond to you there.
Okay, thank you, Nick. All right, we're going to move on to the next section here, which is I'm going to do a quick math, and then we're going to expand on this a little. I actually am going a little long here, but we'll be done by the top of the hour for sure. Quick math. Why is this a big deal? Why do we care about it? One, we care about it because you have to, as we said at the beginning, you have to identify 174 expense. What I'm hearing is taxpayers, and the tax preparers I don't think are listening, or they shouldn't be listening, but taxpayers are saying, well, I'm not going to, let's say, claim an R&D tax credit because I don't want to identify I have 174 expenses. That is not an acceptable tax return. Just because you don't identify 174 doesn't mean they won't exist. You, and I don't think you would do this, but you would be putting yourself out to penalties as the preparer and the signer of this return. Your client would put themselves out to penalties. It's not like because I don't identify, they don't exist. That's not the case. I mean, that's like saying, well, because I don't identify all my income, it doesn't exist. No, that's not the case, obviously, and we know that. Here's a simple math. Year 21, same scenario. Same. Next thing is 22. Year 21, $2.5 million in net income before R&D expenses. $1 million of R&D expenses. In 21, they had taxable income of $1.5 million, $315,000 of taxes at a corporate 21%. Obviously, at an individual rate, this would be a much higher. If it was a pass-through, be much higher tax rate. 22 kicks in. I can no longer write off that $1 million of 174 expense I have. I have to amortize that over 5 years, but technically it's a mid-year convention. And so I only get 10% right off the first year. And so in this scenario, my taxable income is going to increase by 900,000, which is an increase at 21% of $189,000 of tax. This scenario is a $10 million manufacturer. $189,000 of additional tax for just 1 year. We'll expand on this over a 5 or 6 year period in a minute. That's a big tax hit to not a giant taxpayer. And that's why this is a big deal. That's why we have to be doing everything we can to figure out how we can identify these and inform taxpayers on it. So what about the interplay with the R&D tax credit then? I already mentioned, people say, well, and I've heard this way too many times, what if I don't take the R&D tax credit? You should take the R&D tax credit. And I'm going to show you in a minute, the R&D tax credit actually got more valuable under these new rules. Now, it's not going to offset the whole negative effect of the additional income immediately. In the long run, and this is long run, it probably will. So the one thing with the R&D is the what happened when these new rules were identified in 2017, it was like everybody was thinking, oh my goodness, my R&D tax credit is going to go down. If my credit's based on my 174 expenditures for the year, my 174 expenditures just went, let's say this last scenario, from $1 million, which would be $100,000 tax credit probably, to $100,000, which is my amortization amount, which went to a $10,000 tax credit. Luckily, Congress had foresight and they made a conforming amendment that said the R&D tax credit calculation is going to be based on expenditures incurred or paid during the year rather than the 174 expense allowable during the year. So they made a change there, which was huge because it does not affect our credit on the negative impact at all. But in reality, it affects our R&D tax credit positively, because they also made a secondary conforming amendment that was to 280C that says, hey, I only have boy, I don't have a lot of time to go into 280C, but bottom line is 280C says I can take a full credit or a reduced credit. If I take a full credit, I reduce my expenses. If I take a reduced credit, I just take whatever that reduced value is. Under these conforming amendment, what Congress says is in these changes to 174 and 41, is that I don't have to affect my expenses, my current year expenses, by the credit. Don't have to do it at all. What I do have to do is reduce my capital account by any credit value that exceeds my current year amortization. So if I have a $100,000 credit, I have $120,000 or $80,000 of amortization, my credit exceeds the amortization by $20,000. I don't affect my expenses at all. I reduce my capital account by $20,000, which then would reduce my expenditures or my amortization in the future. That scenario is not going to happen very often. Most likely, your credit's going to be lower than the amortization amount. And if that's the case, the value of my credit just went up. Now, this is the way it reads. If you read 280C and you look at the conforming amendment, and I guarantee you this is what they meant. I mean, I suppose they could have made a mistake, but this is the way it reads right now. If I have a $100,000 credit, the value of that credit in almost every situation to me as the taxpayer now is going to be $100,000. Before this conforming amendment, if I had a $100,000 credit, in most situations, the value of that credit was tax affected and it was a $79,000 credit. So the value of my credit actually went up with these conforming amendments, which was nice. Here's a list that and I should spend more time on that section, but here we're running out of time. Here's a list of 174 expenses in the center, 41 expenses on the right. Not everything that qualifies for the credit also is not everything that qualifies as a 174 expense also qualifies for the credit. Only a few things do. And so here's what we're suggesting. Whew, promised you this flow chart. Now we're here. Here's what we're suggesting. If you have a client that's taken an R&D tax credit, or even if they haven't, they should look at it now. And we're doing this for all of our clients, all the clients that we're working with you on. This is this process we're going through to identify 174 expenses. One, let's start with the 41 expenses. Let's start with the expenses that qualify for the R&D tax credit. That's on the left-hand side here. Then to get to 174, let's add non-qualified software development. Not all software qualifies for the R&D tax credit. All software development qualifies for 174. Only certain projects also qualify for 41. So now we have to build in these non-qualified software development projects, add that. For 41, for the credit, wages are based on box 1 of your W-2, taxable wages. For 174, we have to, fully burden those wages, non-taxable, overhead, benefits, things like that. We have to add those back. Foreign research does not qualify for 41, but it is an R&D a 174 expense. We have to add those back. These are all things, those first four there, these are things we identify when we're doing the credit. The last area is not, and this is where we got to work together on this. How do we allocate indirect expenses to my 174 projects? This does not have any guidance out there at all on this. You, as the tax preparer, tax advisor, are used to grossing up certain things for maybe say 263A or different, different areas of the tax code. You already have a policy set in place of how we're going to identify these overhead costs that we have to put somewhere else, let's say. I think what we need to do with these indirect expenses is come up with a reasonable methodology. And if we do that, we're going to be ahead of 90+% of the tax returns filed out there. Come up with a reasonable policy where we're going to, gross up 174 expenses based on, hours of employees, space used within our facility for R&D, some kind of methodology. And that was brainstorm, some kind of methodology that we come up with, document it, put it in our work papers, and now we have proof that we did work on this. That's where we are right now to get to the total 174. Now, in our minds, that total 174 is currently for estimated extension payments, not for filing the tax return. You can, but you very well will have to amend before the end of the year if that's the case, because IRS is going to come out with more guidance on what 174 is. Unfortunately, they've already pretty much guaranteed us that's not coming until after April 15th. And who knows how quick after April 15th. And that's why at this point, we don't think you can file the tax return with 174 on it. Just in case anybody needs to run, I'm going to put the poll, fourth poll up, but I'm going to continue here for about 5 more minutes, and we're over 50 minutes in. So let me put this fourth polling question up just so we can get that, and then I will continue on. In fact, I'm going to talk about this slide while the fourth polling question is up here. Fourth poll, are you looking forward to 4/19, the day after a filing deadline? Yes, no, or it's just another deadline and a never-ending string of deadlines. And I put that last section there for a reason, because unfortunately, it feels like that. We're just nonstop. This isn't a plug, I guess, but I do a presentation on mental health in our profession. Things we can do to avoid it, how we can stop feeling like we're constantly under deadlines. I'm actually going to do a 2-hour version of this at Scaling New Heights. So if anybody's there, I'd love to see you at that conference. But yeah, I'm just curious. This is more of a throwaway question just to get the fourth one in there. But yeah, if you are in that mindset, this never-ending deadlines, that's something that maybe we should talk a little further. All right, we're 93% participated here. I'm going to close this. 61% yes, 3% no, not looking forward to 4/19. Maybe it just seems too far in the future, and 35% just another deadline. Ending that poll, thanks for that. I'm going to continue on now to give you a little more information on the 174. And I've kind of given you our guidance as we gone, extension payment. But let's look at the overall effect of these new rules. Here's a sample taxpayer, similar to what we did above. This is a temporary permanent tax hit. I'm probably saying that wrong. But for the 6-year period, this taxpayer, if you look third from the left, is at a corporate tax rate of 21%. over a 6-year period is going to have an additional $525,000 of taxes. This is a $10 million manufacturer. $500,000 of additional taxes because of these rules is a big deal. Now, the one thing I want to point out is if you look at the R&D tax credit column, second from the left, under the rules, the non-conformed rules that they put in, this credit would have been about 44,000, let's say. It would have been tax affected. It would have been 79% of the 56,000. This is where I'm saying the value of the credit went up. The value of the credit now continues to go up or be larger every year if these rules don't change, if Congress doesn't act and get rid of these rules or kick them down the road. And so, maybe I'll have to extend this out. Maybe 20 years down the road, we actually recoup all these costs, the additional tax. It's probably even going to take longer than that. But at least the value of the credit has gone up based on the conforming amendment in 280C. You can see after the 6th year, we're actually back to whole in this scenario because we have now 6 years of amortization, 5 full years with the half-year conventions in there. So after that, on that 6th year, we're back to normal. If we're not increasing in revenue or expenses or whatever, we're back to normal. This is a temporary hit, but we're going to permanently be out this 525,000, other than the value of the credit increase, and we'll start to eat into that year by year. But that's 12,000 a year that's going to eat into this scenario. That's going to take us really 25 years before we recoup all this additional cost that it affected us. So are there things we can do? The business plan I'm not going to get into, other than we can reshore. Maybe we reshore R&D. Maybe we try to deal with our vendors and put the burden of R&D projects on them rather than us. So this way it becomes a cost of goods sold, maybe, rather than R&D. Question I get, can I use book R&D expenditures? My client books R&D on their GAAP financial statement. Can I use that for 174? Unfortunately, GAAP and tax are different. So you can't. Maybe they'll give you some insights, at least to start digging deeper, but it won't be an accurate number. So be aware of that. We want to file an accurate income tax return. This won't be an accurate number if you follow that. It's going to affect other parts of the tax code. Your interest deduction limitations will be affected. Probably go up, but also kicking in the beginning of the 22, there was adjustments to that too. So that's been negatively impacted overall as well. QBI will be impacted. There's state implications. We've put a form together with all the state implications that we currently know. I'm not sure if we're available to put that out to you yet. We'll probably put that on our website. If you're on our email blast, you'll probably get that, but we have the state implications of this new rule as well. I kind of highlighted what we're saying to do already with the extension payments. And why? Because we just need this guidance IRS is promising. I think we have a good methodology to figure out what a 174 is based on the knowledge we have today. But IRS could come out with something and say, yes, this is completely different. Here's our guidance. You need to treat the indirect expenses. Maybe they'll give us a calculation method for treating the indirect expenses rather than us, following some other tax rules. But that's probably what they'll do anyways. Funded research, is that a 174 or is that not a 174? Software development, is that all expenses? Because like I said, not everything qualifies for 41. Do we get rid of the uncertainty requirement now that software is defined specifically in 174 as a qualified activity? These are things that we need additional guidance on. It is going to come out somewhere between, let's say, April 19th and hopefully be well before September 15th. But this is what we're waiting on. I did polling question 4 already. I just want to thank everybody. I'm going to leave this open for another minute and a half, just so in case anybody logged in a little late. Hopefully you answered all the polling questions. If you have additional questions, reach out to us. That QR code will get you to our website. You can send them to info@Trimerit. You can call our 800 number. You can go to our website. Just follow up with whatever you can. And before we close out, Nick, was there any other questions we wanted to try to address live?
Yep, someone asked if we could just real quick recap what our recommendations are around extension payments around that. I know we had a slide on it a little bit, but
Yep. So this is all your decision. What we're thinking that should be done is use that flow chart that we showed you to figure out what a client's 174 expenses are. Use that to determine what their taxable income is going to be, and then come whatever the deadline is, March 15th or April 15th, put your extension in and use that estimated 174 capitalization and amortization amount to figure out what the net taxable income is going to be for the year and go from there. And in addition, you may want to make an estimate for an R&D tax credit if you think they have that as well. But at this point, it's probably better to estimate conservatively on the conservative meaning, put more into 174 than you think, because it's easier to ask for a refund than to ask for forgiveness when you're underpaid. I got a feeling IRS is going to have a lot of underpayment issues this year with 174, but try to at least overestimate the amount of taxable income. So that's what we're suggesting. Use it for extension, not filing, because if you do file, you very well are going to amend later because of the guidance that comes out, or hopefully because Congress acts and they get rid of this, or at least delay it for another 5 years or something. Anything else, Nick?
No, that was it.
All right, well, we are at the top of the hour. Again, thanks, everybody. We will have another webinar coming out next month. Hasn't been decided on the topic, but it very well may be the tax incentives that are in the Inflation Reduction Act that we will be putting out as a service. And this will be another opportunity for you to be this advisor to your client. So look for that. I'm sure you're on our email list. You can go on our website and check it out, but we will have one next month as well. And thanks again, everybody, for being here.